Our mission today is an exploration of the hidden operating system behind financial outcomes. We're looking beyond spreadsheets, beyond market analysis, and straight into the human brain.
We are diving deep into what the source material correctly identifies as financial psychology.
And the single best way to introduce this concept is with an almost unbelievable yet entirely true contrast between two men.
Right. Their lives illustrate this core idea perfectly. Financial success is often, completely unrelated to traditional intelligence or education.
Let's start with character one. He was a high-level technology executive, highly educated, and by all conventional metrics, just immensely successful.
He made so much money so fast that he seems to have just fundamentally lost touch with the value of a dollar.
The anecdotes are staggering. The source material talks about an occasion where, purely for fun, this executive took $1,000 gold coins out to the Pacific coast.
And he threw them into the ocean.
He threw them into the ocean, challenging his friends to see whose coin could skip further.
Treating immense wealth like disposable skipping stones, it's just hard to even imagine.
And this wasn't, a one-off thing. On another occasion, he's at this high-end hotel, and he breaks a lamp, a $500 lamp.
Okay, an accident. That happens.
But instead of just letting the hotel handle it, he reaches into his jacket, pulls out $5,000 in cash, and slams it on the table.
10 times the value.
10 times. And he tells the manager, and this is a direct quote, "Now get out of my face and never insult me like that again." It's just pure, reckless arrogance.
Okay, so hold that image in your mind. This incredibly wealthy, arrogant executive. Now, let's contrast him with character two, Ronald Read.
Ronald Read, a humble janitor and a gas station attendant from rural Vermont.
He was the first person in his family to even finish high school. He never made a huge income.
Lived in the same modest house his whole life. It was a $12,000 two-bedroom house. His main hobby was chopping firewood.
You could not paint a more different picture.
And the outcomes here, they defy all conventional expectations. The reckless tech executive.
Oh.
The guy who treated money like a plaything.
He lost everything.
Lost everything. Not long after those displays of just pure hubris, he was wiped out.
But the humble janitor, Ronald Read, he died in 2014. And the world was just stunned to discover that over his lifetime, he had quietly accumulated a net worth of over $8 million.
$8 million. And he became this post-mortem philanthropist. He left the vast majority of that sum to a local hospital and his community library.
This is the absolute crux of our deep dive. Experts and academics, they struggle to explain Ronald Read's success versus the executive's spectacular failure.
You can't. Not with conventional models. You can run all the spreadsheets you want, you can analyze every trading day, but you cannot explain an $8 million outcome from a janitor's salary purely through, market timing or some hidden brilliance.
It demonstrates the core premise we're tackling today. Financial success is not a hard science. It's not about raw intelligence or technical skill.
It's a soft skill. It's driven almost entirely by behavior, by patience, humility, and the ability to play a very, very long game.
So our mission today is to explore those behavioral rules so that you can consciously adopt the mindset of Ronald Read and, just as importantly, avoid the fatal flaws of that arrogant executive.
So let's unpack this central thesis, that success is rooted in behavior, because this is where it gets tricky, right?
It's not something you can just learn from a textbook.
Exactly. You can't teach behavioral skills easily, even to very smart people. You can have an educated genius who just cannot control their fear and greed.
And they can be a total financial disaster.
A total disaster. Meanwhile, an ordinary person, someone with no formal financial education, can build generational wealth.
Just by mastering a few simple behavioral skills.
Right. And this brings us to the first big insight from the source material, which I find so fascinating. The idea that nobody is truly crazy.
Okay, explain that. Because when I hear about someone throwing gold coins into the sea or buying thousands in lottery tickets, my first instinct is to think that's a crazy decision.
Of course, it's a natural reaction. But the source material pushes back, and it pushes back hard against that simple judgment.
So what's the alternative?
The core insight is this. When people do things that look crazy with money, nobody is actually crazy. Every single person's financial decisions, no matter how outlandish they look to us, make complete sense to them.
Because they're acting logically within their own unique framework.
Precisely, their own unique lived experience.
This idea of the personal anchor is so profound and honestly a little terrifying. The source explains that your personal experiences with money, your own life, it's this tiny, tiny fraction, maybe 0.000000001% of what happens globally.
A statistical rounding error.
But that same tiny fraction accounts for roughly 80% of how you think the financial world works and how you make all your decisions.
It's the small sample size problem, writ large across humanity. We are all anchored to what we experienced in our formative years, and we just assume that our experience is the universal truth.
I mean, you can see this so clearly in the generational impact on investing.
Absolutely. Let's take two people, both equally smart, both living in the U.S.
Okay, so person one is born around, say, 1970.
Right, so during their adolescence and their 20s, what do they see? They saw the S&P 500 increase tenfold, even after you adjust for inflation.
For them, the market is this unstoppable money-printing machine. It's just what it does.
It's their reality. Now, take person two, born just 20 years earlier in 1950.
So their formative years are the 1970s and early 80s.
Exactly. A period of high inflation, recessions. The stock market was essentially flat for over a decade. They grew up believing the stock market is a dangerous, volatile place where you lose your money.
So if these two people meet today to talk about investing,
They're going to have fundamentally different, often conflicting worldviews. And their disagreement isn't about math. It's not that one is smarter than the other.
it's that they have radically different yet equally true personal histories with money.
And that anchoring effect, it extends deeply across socioeconomic lines. It leads to behaviors that, from the outside, seem completely irrational, but from the inside are deeply logical.
Let's get into the really challenging example here, lottery tickets. The data shows that low-income families in the U.S. spend, on average, $412 a year on lottery tickets.
And that's 4 times the amount spent by high-income families.
This is where it feels so contradictory, right? We know that roughly 40% of Americans can't cover a $400 emergency.
Yet they're spending that exact amount annually on a game with astronomical odds against them.
As an outsider, that just seems like a fundamentally irresponsible choice. I mean, that $400 could be the start of that emergency fund. So where does the source draw the line between, understanding the behavior and just calling it financial negligence?
The line is defined by the unique framework of their lives. For someone living paycheck to paycheck, the problem isn't just a lack of savings.
It's deeper than that.
It's the fundamental lack of a clear path to financial mobility. They're already dealing with overwhelmingly bad odds in their daily life.
When you think about the conventional financial advice, save 15% of your income, buy a diversified index fund, wait 30 years.
That advice is designed for someone with a stable, growing income, someone who has a margin for error.
It's not designed for someone juggling multiple minimum wage jobs with massive medical debt.
Exactly. For that person, the conventional path to success feels completely blocked. It sounds like a fairy tale. So that $412 spent on a ticket, it's not seen as an investment.
It's something else entirely.
It's seen as the only moment they can palpably dream of getting the good things. A debt-free life, a down payment, freedom from worry that wealthier people either already have or can easily acquire.
So it's the cost of hope. It's an emotional purchase. It's buying a tangible dream, even for a moment.
And this is where the psychology is so important. The financial writer Morgan Housel, who wrote the source material, notes that the people who read books about saving and investing, well, they either already possess those good things or have a very high chance of getting them.
So their perspective, the view from financial stability, is completely alien to someone for whom the lottery feels like the only viable escape hatch.
Right. Their decision is logical, but only within their unique high odds against them framework.
This is all complicated even further by the fact that so many of the financial challenges we face today are incredibly new. I mean, in the grand scheme of human history.
They're all basically financial newbies, just collectively improvising solutions as we go.
Take retirement. The whole concept of stopping work at 65 and living comfortably for another 20 years, that's barely 2 generations old.
It really is. Before World War II, the vast majority of Americans just worked until they died. The workforce participation rate for men over 65 was over 50% until the 1940s.
It wasn't just common, it was the expectation. The whole financial model of society was based on continuous labor.
And then suddenly, society shifts. Social Security benefits started out tiny. It took decades for the average check to provide any kind of meaningful independence.
And now we've shifted to 401ks and mandatory personal savings.
which requires a level of long-term planning, diversification, and behavioral control that our species simply hasn't developed a deep cultural consensus around.
So we're building this massive, complex system of personal retirement savings in an environment where there's no accumulated multi-generational experience to draw on.
It's no wonder people struggle with the discipline. It's not in our DNA yet.
And the same thing, this rapid societal shift, applies to higher education, which is a huge driver of the student debt crisis.
100%.
Yeah.
In 1940, less than 5% of Americans over 25 had a college degree. By 2015, that number jumped to 25%.
We normalize the cost and the necessity of a college degree in less than a single lifetime.
And at the same time, the average cost of that degree has gone up more than fourfold, even adjusted for inflation, since the 1970s.
So the financial equation changed radically, but the cultural expectation that college is the required gateway to success, it didn't.
And the result is this massive student loan debt problem. It's society grappling with a brand new, gargantuan financial pressure that just didn't exist for our grandparents. We are all improvising without a playbook.
So if we accept this, that nobody's crazy, that we're all just acting logically based on our own anchored experiences within these rapidly evolving systems, it completely changes how we should approach self-improvement.
It has to. You have to be aware of your own biases, your own anchors, before you can even start to implement a new strategy.
Which builds perfectly on our next point. Once you realize individual intelligence isn't enough, you have to confront the external forces.
Right. The chaos. The source material forces us to confront this reality that individual effort, drive, and genius are never the sole drivers of outcomes.
The idea that nothing is as good or as bad as it seems, that perfectly encapsulates this section.
It really does. Luck and risk, the source contends, are siblings. They're two sides of the same coin. And if you believe in the monumental power of luck to create a great outcome, you have to equally respect the terrifying power of risk to destroy one.
The Bill Gates and Kent Evans story is the most perfect and honestly the most chilling illustration of this.
Everyone knows the story of Gates's genius and drive, but far fewer people appreciate the sheer, unadulterated stroke of luck that set him on his path.
He attended Lakeside School in Seattle. In 1968, Lakeside was one of the only high schools in the entire world that had a computer terminal.
Just think about that. They leased it for $3,000 a year. It's an extraordinary piece of good fortune.
So it put a 13-year-old Bill Gates in contact with this groundbreaking technology that most university graduate programs didn't even have access to at the time.
It gave him a foundational, multi-year head start on the entire industry. That is luck. Pure and simple.
And his friend, Kent Evans, was right there with him. Equally brilliant, equally driven.
Gates himself says that Evans could have easily been a co-founder of Microsoft. Their skills were that comparable.
But that's where their paths just tragically diverged.
Kent Evans died before he even finished high school. It was a mountaineering accident, a risk that is, statistically, about 1 in a million.
And the analysis of this is just crucial for anyone listening.
It is. You have the exact same force. A highly improbable 1 in a million event working in completely opposite directions for two highly capable people.
Gates benefited from the long tail of positive technological luck.
And Evans was caught by the long tail of devastating personal risk.
So we can look at Gates and we can pull out lessons about hard work and vision, and those are true. But if we ignore the luck, we're ignoring the fact that the same level of genius right next to him was just wiped out by chance.
And this is why we struggle to learn from history. We seem pathologically determined to ignore luck and risk, I think, because they're just so difficult to measure.
It's human nature, right? We prefer simple, clean narratives. The source calls them diabolically misleading.
And they are. Because it's hard to quantify exactly how much luck contributed to someone's success. And, let's be honest, it's often considered rude to suggest that someone's hard-won wealth might be partly due to chance.
And we apply this asymmetry to ourselves, too. When we fail, we often blame a dark side of risk. I made a good decision, but I got unlucky.
But when we assess others who fail, we go for the simple story. He failed because he made a bad, greedy decision.
That preference for simplicity, it creates a massive blind spot, especially when we look at historical examples of success.
The source uses the history of the great American magnates to show just how thin the line is between being audaciously innovative and being recklessly criminal.
Look at Cornelius Vanderbilt. He famously said, "What do I care about the law? I have power, haven't I?" He built a massive empire through shrewd, often legally questionable methods.
And John D. Rockefeller, who frequently bent and broke laws in his quest for a monopoly. His actions are often celebrated today as the height of business genius.
The narrative hinges entirely on the outcome, doesn't it?
Completely. The only real difference between disrupting outdated structures and committing fraud is often just whether or not you succeed in the end.
If Vanderbilt had failed, those words would be on his tombstone as proof of his recklessness.
If Rockefeller had been shut down early, he'd be a historical footnote.
In the context of today's tech founders, where move fast and break things is a motto, where does that line between disruption and recklessness even lie?
Well, the source argues that the line basically disappears if we don't properly account for the immense, unmeasurable role of luck and risk. The point isn't to judge them.
The point is to recognize that the forces shaping their outcome, the unique economic moment, the political landscape, are too extreme and too rare to be replicated by the average person.
Even the titans of financial thought admit this. Benjamin Graham, the father of value investing, he admitted his single greatest success came from owning a huge stake in Jayco.
A move that explicitly violated almost all of his own published rules on diversification.
He couldn't even tell you if his best financial moment was a stroke of brilliant foresight or just dumb luck.
And that ambiguity is the lesson.
That's the lesson. As observers, we have to practice extreme humility when we study success. If you're reading the biographies of billionaires, the extreme outliers, you're often trying to learn lessons from behaviors that only work because of a one-in-a-million lucky break.
So what does this mean for the listener? I mean, we all want actionable advice. What's the takeaway?
The actionable advice is this. The more extreme the outcome you're studying, a spectacular billion-dollar win or a devastating failure, the less applicable the specific tactical lessons are to your life. The signal is just drowned out by the noise of extreme luck or extreme risk.
So instead of trying to be the next Elon Musk, we should
focus on the broad, common, replicable patterns of success. Things like saving consistently, minimizing debt, maintaining low-cost diversification.
The Ronald Read approach.
Exactly. The humble, consistent approach that he mastered, not the pursuit of some high-risk, high-luck gambit.
That brings us perfectly to the next psychological hurdle, the huge difference in mindset required to get rich versus the mindset you need to stay rich.
Yes, getting rich requires taking calculated risks, being optimistic, getting yourself exposed to opportunities. But the source material makes a really compelling case that staying rich requires the opposite.
Humility, frugality, and crucially, a kind of financial paranoia.
The central conflict here is ambition versus contentment. The hardest thing to do with money is to just stop moving the goalposts.
When people get positive results, their expectations rise faster than their actual net worth.
And they end up feeling like they're falling behind, even though they're making progress, which then justifies taking on more and more risk to catch some ever-receding target.
We see this so clearly in the spectacular falls of people who already had more than enough. I mean, the case of Rajat Gupta is just staggering.
Staggering. He started with nothing, rose from the slums of Calcutta to become the CEO of McKinsey. He retired with an estimated $100 million fortune.
He had it all. Prestige, power, true generational freedom.
Complete freedom. A 5% annual return on his wealth would earn him almost $600 an hour, $247, without him ever having to lift a finger again.
That is true financial mastery, and yet...
Yet he wanted more. He wanted the ultimate status symbol, to be a billionaire. And this ambition led him to betray his position.
He was on the board of Goldman Sachs during the 2008 crisis.
And he learns that Warren Buffett is about to invest $5 billion in the bank, a piece of insider information that would instantly move the stock price.
And the detail that just highlights the psychological flaw here is the timing.
16 seconds. 16 seconds after hanging up from that board meeting, he's on the phone with a hedge fund manager, tipping him off.
It led to about $1 million in immediate illegal gains for the fund manager.
And for that, he risked everything. His freedom, his reputation, his $100 million in earned wealth, for a marginal gain that he did not need.
What wire gets crossed in your brain when $100 million isn't enough?
It's that constant moving of the goalposts, and it's fueled by envy. It's the moment when enough stops being a functional number and becomes purely a comparison to someone else.
He was looking at the Buffetts and the Zuckerbergs and deciding his own staggering success was somehow insufficient.
The same thing is true for Bernie Madoff. He was running a hugely successful, completely legitimate market-making business that was generating $25 to $50 million a year for him.
Before he started the Ponzi scheme that ruined everyone.
This is a tragedy rooted in behavioral flaws, not in bad financial models.
Warren Buffett famously dissected this behavior when he talked about the failure of the hedge fund long-term capital management.
Right. LTCM. Its founders were brilliant, Nobel Prize-winning economists who still risked their personal fortunes chasing even higher returns.
And Buffett said, to make money they didn't have and didn't need, they risked what they did have and did need. That is stupidity. It is pure and simple stupidity.
Stupidity defined not by a lack of intelligence, but by a total failure of behavior.
So how do you fight that? How do you combat that insatiable appetite in your own life?
You have to make a crucial psychological distinction. Winning money requires risk and optimism. Keeping money requires the exact opposite temperament: humility, intense frugality, and paranoia.
If you had to boil down the source material's advice for long-term financial success into a single word, what would it be?
Survival.
Survival. That's an excellent concept because capitalism is inherently brutal and unforgiving.
It's merciless. The source notes that roughly 40% of companies that become successful enough to be public eventually lose all their value.
They die, they merge, or they get delisted.
And even among the financial elite, the Forbes 400 list sees a 20% turnover every decade. And that's excluding people who die or transfer their wealth. The forces of disruption are constant.
So longevity isn't just a byproduct of success. It is the definition of success.
Absolutely. This is why compounding is the greatest mathematical force in finance, and it is entirely dependent on survival.
Because compounding requires years, decades of uninterrupted growth.
Which means you have to survive the inevitable, unpredictable highs and lows. You need the psychological fortitude to just stay in the game when everyone around you is panicking.
I remember the example of Michael Moritz, the billionaire director of Sequoia Capital. He attributed their 4 decades of astonishing success in venture capital, a world defined by risk.
Not to their growth strategies or vision, but to being always afraid of going broke.
That paranoia is a strategic asset.
It is. It means you never get complacent. You always maintain sufficient cash reserves. You never over-leverage. You assume tomorrow will not be a repeat of yesterday. That paranoia is the anti-fragility you need to endure the market's constant attempts to kill you.
So we spend years studying Warren Buffett's investment genius, but the source suggests it's maybe more important to study what he didn't do.
Exactly. He didn't load up on debt. He didn't panic and sell everything during the 14 recessions he's lived through. He never leveraged his company to a point where a single downturn could wipe him out.
His genius wasn't just in picking the winners.
He was in the behavioral discipline to survive the losers and the chaos long enough for the winners to compound.
The ultimate cautionary tale here, the one that illustrates this fatal flaw of lacking paranoia, is Rick Guerin.
Guerin. He was part of the original brilliant trio with Buffett and Charlie Munger. Equally smart, but the source says he was, quote, in a hurry.
And that hurry killed his compounding.
It did. He leveraged his investments heavily, using margin-borrowed money to amplify his returns. That strategy is brilliant when the market is going up.
But when the market crashed by 70% in 1973-74...
he was hit with margin calls. His brokers demanded he immediately put up more cash, or they'd be forced to sell his assets to cover the loans.
At the absolute worst possible moment.
Precisely. Because he was too aggressive, too impatient, and lacked that margin of safety, he was forced to liquidate his shares at the bottom of the crash. And crucially, this included his Berkshire Hathaway stock,
which he sold to Warren Buffett for less than $40 a share.
He broke the cardinal rule. Never interrupt compounding unnecessarily. He had this fantastic long-term asset, but because he lacked the financial paranoia and the patience, he was forced to sell low.
Buffett, by contrast, had the cash, the paranoia, and the margin to survive, and decades later, those same shares were worth hundreds of thousands of dollars each.
Guerin's story is the perfect illustration. Volatility is the price you pay for admission, and impatience, combined with leverage, is the single most effective way to guarantee you won't survive long enough to reap the reward.
That concept of volatility being the price, not a punishment, is such a powerful psychological tool. It helps us transition into 2 closely related traps.
The mistaken belief that financial success comes without a cost, and the danger of copying the strategies of people who are playing a totally different game than you are.
Let's start with the cost. It's so easy to look at a successful outcome, like a company that's compounded at 12% a year for 30 years, and just assume the journey was easy.
Right. The former CEO of GE, Jeff Immelt, He said that when he stepped down, he realized, every job looks easy when you're not the one doing it. We only see the successful outcome, not the brutal internal struggle.
And this applies directly to market returns. The S&P 500 returned about 11% annually from 1950 to 2019. That is an objectively fantastic return.
It's enough to build generational wealth, easily. But you have to ask, was that return free?
And the answer is absolutely not.
The price for that high return was the endless turbulence of the market. The panics, the recessions, the 102 times the market dropped by more than 10%, the 12 times it dropped by more than a third. Those moments felt terrifying.
That terror, that uncertainty, that volatility, that is the fee.
And the critical mental shift the source urges us to make is to see that volatility not as a final punishment for doing something wrong, but as a necessary fee.
The fee for market access and long-term compounding.
It's like buying a ticket to a theme park. Okay. You pay the fee, and you accept that the cost of admission includes standing in line and dealing with crowds. If you see a market crash as a fine, your instinct is to get out, try to avoid the punishment, and sneak back in later.
But if you see volatility as the mandatory fee for access, you just accept it as the cost of doing business, and you stay invested.
If you try to execute the heist, getting the high returns without paying the fee, maybe through day trading or market timing, you inevitably end up paying double.
This attempt to avoid the fee is exactly what so-called tactical funds promise, isn't it?
It is. These are funds designed to minimize downside risk by actively moving assets into cash before a crash and then buying back in. They're supposed to be the perfect defensive strategy.
But the data is just brutal.
It's brutal. Morningstar studied 112 of these funds during a volatile period in 2010-2011, precisely when they should have excelled. The result? Only 9 of them performed better than a simple, boring 60-40 mix of stocks and bonds.
And less than a quarter of them even had smaller losses than just regular non-tactical funds.
The irony is rich. By trying to avoid paying the necessary fee of volatility, these investors ended up paying double in management fees, taxes, and opportunity cost, while often failing to even reduce the downside risk they were trying to escape.
The behavioral failure here is believing the system can be gamed.
And that desire to game the system often leads directly into the second major trap: copying the strategies of others without understanding what game they're actually playing.
We tend to look at bubbles, like the dot-com era, and we blame them on generalized greed or irrationality.
But the source argues they're much more complex. They're rooted in a time horizon problem, a price that seems utterly absurd to you, the long-term investor planning for 30 years.
Can be perfectly rational for a short-term trader who's just betting on the stock rising by lunchtime?
Let's use the dot-com example. A long-term investor who paid an astronomical price-to-earnings ratio for Yahoo shares in 1999 suffered a disaster.
And for anyone who needs a refresher, the PE ratio compares the share price to the company's earnings. When it's astronomical, the price is only justified if earnings grow impossibly fast for decades.
Right. For a long-term investor looking for future cash flows, that's a terrible investment. But for a day trader in 1999,
for them, paying that same price was perfectly rational.
Because they only needed the price to tick up slightly before they sold it again, maybe within the hour. They weren't betting on future earnings, they were betting on short-term momentum.
And this is where bubbles become so toxic.
It's when the short-term traders start defining the price of the asset. And then the long-term investors who are playing the 30-year game start taking their cues from the short-term players. They adopt a price point that is utterly destructive to their actual long-term goals.
So the core lesson is intense self-awareness. You have to identify your own game, your own time horizon, and stick to it no matter what everyone else is doing.
And this time horizon problem, it extends beyond the stock market and right into our social lives. It influences our spending.
So much of modern spending is driven by social influence, right? The need for visible status.
Exactly. We look at a high-status professional, a lawyer, a doctor who buys a huge house, a luxury car, takes exotic vacations, and we're subtly influenced to copy that spending.
We copy the actions we can see, hoping to get the same respect.
But we can't see their income game. We don't see their net worth, their debt load, their unique career trajectory. We don't know if that luxury car was financed over 8 years at a terrible interest rate.
So if your income game is fundamentally different from theirs, copying their visible spending just leads to fragility and disappointment.
And an unnecessary interruption of your own compounding potential. Financial behavior is the one area where comparing yourself to others is almost guaranteed to destroy your own best intentions.
So the ability to avoid these traps and successfully navigate the financial world, it really comes down to mastering three core psychological skills.
Efficiency in saving, protection against the unknown, and humility about the future.
Let's start with efficiency. Chapter 10 makes a compelling case for saving without a specific goal.
It argues that wealth creation has less to do with high income or spectacular returns and everything to do with your savings rate, with frugality and efficiency.
The source uses a brilliant analogy based on energy.
Right. The U.S. uses 60% less energy per dollar of GDP today than in 1950. Why? Not because we found dramatically more oil, but because we became dramatically more efficient in how we use energy. We solved the problem by needing less demand.
And savings is the financial equivalent of that efficiency.
Saving more means you need lower expenses, which means your existing savings covered a longer time frame. It dramatically increases your independence.
And this is the insight that's so often missed. You don't need a specific high-status reason, a boat, a vacation home, to save.
You should save just for saving's sake.
Why?
Because that money provides protection against life's unpredictable surprises. It gives you flexibility, time to think, and most importantly, control over your own time.
Every bit of saving buys back a moment of your future independence.
And that independence, that control over your time, is the greatest financial dividend of all.
Which leads directly to the second lesson, the essential margin for error. We often think of having a margin of error as being conservative, like you lack confidence in your plan.
But it's precisely the opposite. The margin of error is the aggressive strategy because it's what allows you to survive a wide range of outcomes long enough for compounding to work its magic.
The source puts it simply, the most important part of any financial plan is having a plan for when the original plan isn't working.
And you have to plan for what you cannot predict. The source material uses this chilling historical example from the Battle of Stalingrad in late 1942.
The German tank unit. They had 104 sophisticated cutting-edge tanks sitting in reserve, desperately needed on the front line.
But when the time came to deploy them, fewer than 20 were operational. They were useless.
And that's
the cause.
Mice.
Field mice. They had nested inside the complex vehicles during the cold and chewed through the electrical insulation.
So the most sophisticated weaponry in the world was defeated not by superior enemy tactics, but by a biological risk that no engineer in 1942 could have possibly anticipated. The field mice destroyed the entire strategy.
The financial equivalent of field mice are the unknown, unpredictable, massive expenses that can undermine an otherwise sound financial plan.
So what do these financial field mice look like for the average person today?
They're an unexpected chronic illness that limits your ability to work, a global pandemic that shuts down your specific industry, a lawsuit, the unexpected cost of caring for an aging parent. These are the single points of failure.
So if your entire plan relies on one paycheck, one industry staying stable, and perfect health, you have no margin for error against the financial field mice.
You have to protect yourself against risks you can't even predict or comprehend. You do that by having liquidity, a savings buffer, for things you literally can't name.
It's about intense humility in your forecasting.
If your plan hinges on the market returning precisely 8% a year for the next 30 years and anything less means disaster, your plan is too brittle. The psychological hedge is to assume your returns will be a third lower than historical averages.
And if the future proves better, it's a wonderful surprise. If it proves worse, you had enough margin to sleep well at night.
Which is the ultimate goal.
Next, we have to talk about the behavioral rigidity that destroys long-term plans. Embracing change, which means abandoning sunk costs. We all suffer from what psychologists call the end-of-history illusion.
Right. We believe we've changed a lot in the past, from our 20s to our 30s, for example. But we narcissistically believe that the version of ourselves today is the final version, that will change very little in the future.
But our goals, our desires, our definitions of happiness, they will inevitably change.
And that failure to anticipate change is why people regret extreme financial plans. They regret working endless hours for high income or living on extreme frugality, because when their goals inevitably change, the disadvantages of those extremes become lasting, painful regrets.
The plan that worked for the 30-year-old you will inevitably cause conflict for the 45-year-old you.
The key is accepting that change is a fact and acting quickly to adapt. This requires abandoning sunk costs.
And for anyone who needs a reminder, sunk costs are the time, money, or effort you've already invested in something that you can't get back.
Psychologically, we feel compelled to continue down a path just because we've already invested so much. But rationally, that past investment should be irrelevant to the decision to move forward.
The source tells the story of the psychologist Daniel Kahneman, who was famous for his ability to completely scrap and rewrite entire chapters of his books.
He'd explain, "For me, there are no sunk costs." He could walk away from months of work because he recognized that the time already spent was irrelevant if a better path forward existed.
The sooner you can cut your losses and adapt, whether that's changing careers or admitting an investment isn't working, the sooner you get back to the quiet power of compounding.
And the greater the chance you have of avoiding deep future regret.
Finally, let's address the persistent, loud noise we all constantly hear. The seduction of pessimism.
We are constantly bombarded by negative financial outlooks, and the source explains exactly why pessimism always sounds smarter and more plausible than optimism.
Pessimism sounds sophisticated. It sounds like someone is offering critical analysis and, crucially, offering help. Optimism often sounds naive, like a hollow sales pitch.
Look at historical examples. In 2008, when everything was terrible, the Wall Street Journal featured a professor who predicted the U.S. would split into 6 separate countries by 2010.
A catastrophic prediction that was taken very seriously at the time.
Now imagine an equally optimistic prediction made in, say, 1948 about Japan's post-war economy. If someone had predicted Japan would experience 15-fold economic growth and become a global leader in innovation, they would have been ridiculed as delusional.
Yet that optimistic outcome is exactly what happened. So why do we latch onto the bad news so easily?
It's rooted in evolutionary psychology. Loss aversion is protective. We are wired to focus on threats, because ignoring a threat could mean death. We're designed to notice the bear in the bushes.
And furthermore, destruction is swift and dramatic. A war starts in a day, a market crashes in a week.
This makes destruction easy to narrate and easy to sensationalize. Growth, however, is slow. It's compounding. It's nonlinear. To appreciate it, you have to look at long, complex histories that are easy to forget.
The Wright brothers flew in 1903, but it wasn't until 1908, 5 years later, that the world really woke up to the invention. People were just so convinced that flight was impossible.
We are constantly surrounded by bad financial news because money affects everyone, and our psychological wiring makes it essential to recognize this bias and stay committed to the long-term, quiet, non-dramatic truth of compounding growth.
We've established today that the rules in personal finance are behavioral, not technical. True financial mastery is mastering your own psychology, not the market.
So let's reflect on the final lessons we've distilled from this deep dive.
First, practice radical humility. Be humble when things go well, recognizing the role of luck, and forgive yourself when they go badly, respecting the role of risk.
Second, prioritize frugality and independence. Less ego equals more wealth. Wealth is what you don't spend and don't see. Your savings rate is more in your control than anything the market gives you.
Third, seek the strategy that helps you sleep soundly at night. Manage your money to achieve comfort and security, not to find the single mathematically optimal strategy. Find the one that works for you.
Fourth, relentlessly increase your time horizon. Time is the most powerful force in investing. A simple, consistent strategy held for decades will always outperform a complex strategy that gets interrupted by panic.
That's how Ronald Read became an $8 million philanthropist.
Fifth, use money strategically to gain control over your time. That independence, the ability to do what you want, when you want, with whom you want, is the greatest financial dividend of all.
Sixth, always guard your money with strategic paranoia. Save for the unpredictable field mice. Define your price for success, treating market volatility as a necessary fee, not a punishment.
And finally, define your game. Know your time horizon, know your goals, and absolutely do not be influenced by people playing a fundamentally different financial game than you are.
To leave you with a final provocative thought, let's return to the idea that there is no single right financial answer.
The source material recounts a disturbing story from 1931 about a patient named Clarence Hughes. He died shortly after his dentist, while Hughes was under heavy anesthesia, pulled 16 of his teeth and removed his tonsils.
Procedures Hughes had explicitly not consented to.
His wife sued. But in 1931, the legal and medical ethos often assumed the doctor knew the one correct way to cure the patient. The patient's opinion was largely irrelevant.
Medicine has since shifted, of course. We now recognize that patients have radically different views on what constitutes a worthwhile treatment or outcome.
The financial world follows this same principle. Your goal is not to find the mathematically rational, ideal, one-size-fits-all strategy that works for everyone.
Your goal is to find the reasonable strategy, The one that aligns with your unique experiences, accepts your personal capacity for risk, and most importantly, allows you to master your own behavior and live a life where you feel in control.
That is the ultimate mastery of financial psychology. We hope these insights help you build that foundation of behavioral excellence.